Now, if you read up on news, you realize that there's a lot of articles that mention that retail sales is really in bad shape and that government needs to step in to save the whole retail industry. If you go on YouTube, very often you see advertisements that show that e-commerce is really going to take over retail industry itself and that is the future. And my father-in-law also agrees. He's in the retail industry for many years. He does luggages and stuff. And he shared with me also that this is about the most challenging period he's seen across his whole 30-40 years in this business, in retail space. So today I'll be sharing with you a few data points, a few surprising conclusions you actually come to realize. I'll be sharing with you data points that show the trends in supermarket sales, that shows the trend in electronic sales, and lastly I'll also be sharing with you data points that show the trend for F&B sales, because all this affect many businesses in Singapore and even affect REITs in Singapore. So if this topic interests you, continue watching on. Hi guys, welcome back. I have very interesting charts prepared for you and let me dive on to it right away. This is the first chart that I've prepared for you to see. This is actually to show you in terms of retail sales, the volume as well as the percentage contributed by online sales itself. And the top chart, let me explain it. As you can see, in January, $4.1 billion of retail sales was clocked. And because of this pandemic, COVID-19, what actually happened is retail sales actually suffered tremendously. It declined all the way to May. And coincidentally, what can be seen from the bottom chart is actually in that period, because of circuit breaker measures, people were not allowed or discouraged from going out to purchase things. Online transactions actually started to climb tremendously. In January, it was only 5.8% of all retail transactions. But as of May, it climbed to 24.5% of all retail sales. So it's quick to conclude things, maybe e-commerce is the way forward and that is going to be permanently a dominating force. But the subsequent chart that I'll show you, which I'll pull up right now for you to see, is that the percentage of retail sales contributed by online actually peaked out in May. So what happened subsequently in June and July, it started to decline. Take note also, in 19 June 2020, that was where actually circuit breaker 2 measures started to be implemented. Things started to be relaxed, people started to go out again, people started to shop in the malls itself. And what can be seen is the peak was actually clocked in May. Subsequent months showed a decline. My guess is that e-commerce will see a new plateau that's elevated. It will not go back to 5.8% of total retail sales, but neither will it be the 20 over percent range. It could possibly fall to the 8 to 11% and settle there because people have gotten used to transacting more online. They have gotten past that fear or gotten used to that convenience. So it really shows that e-commerce does show a growing pie, but it may not be as large as what many marketers present it to be, or how terrifying the news articles actually present it to be. The second part of the chart actually shows that retail sales has started to recover since May because relaxation. People started to go out more, people started to have this pent-up demand to spend money, and June and July actually saw a climb in terms of numbers. The August and September data is not yet in. My guess is September will actually recover back to the January statistics of $4 billion. I think that is a pretty good guess. So this goes to really highlight the first point. Are we in a tech bubble? Because there's so many people that believe that technology is the way forward and technology is going to control e-commerce. The first question is, are we really in a tech bubble? But I do know that these numbers are really Singapore sales. American sales may be very different. China sales may be very different. But the key question that we need to ask ourselves is, are we in a tech bubble? Because Amazon, Facebook, all these tech players seem to be the solution of commerce moving forward. This article actually asks this question. And they believe that right now we are in a tech bubble. Something not seen since 2000, because there's a lot of unicorn startups really driving a lot of valuations with very little profitability and just a promise of future domination of their markets. If we look to a different article, this article states that tech is not in a bubble. Majority of people surveyed, 56% actually feel that tech is not a bubble. 70% actually expect a further 5% increment in terms of tech stocks valuation for the next 12 months. Now take note also, majority of people usually get it wrong, so keep that in mind also. If you ask an expert, this guy is from UBS Wealth Management, one of the world's largest wealth managers. He says tech stocks are not in a bubble and there are 3 ways to position for the next bull market. So leave in your comment sections what you think. Is technology in a bubble or not in a bubble? I'll be keen to hear from you also. But let's draw back to the Singapore context and the question whether e-commerce would really disrupt the whole retail sales and really impact malls and malls such as Capital Mall Trust, such as Frasers, Centrepoint Trust. These are retail malls and they derive a lot of revenue from retail sales itself. And I've actually data points that I've actually put out from CICT, and how we'll run this discussion today is following these few key points. Let me put this out for you to see. I'll start off by touching on supermarkets, then subsequently I'll be touching on computer and telecom sales as well as furniture sales, and lastly I'll end off with F&B sales. Now the first segment that I'd like to share with you is actually on supermarket sales, and let me pull up this graph over for you. To interpret this graph, this is actually plotting across the months the percentage of sales being done online. The bottom blue line is actually on supermarket sales. And what can we conclude? This blue line has been growing, correct? So from January all the way to July, more and more percentage of sales is being done online, which means everybody is getting quite used to buying their frozen chicken, buying their vegetables, all online. Don't need to go and pick and choose like old aunties at the supermarket. And this is actually very surprising because circuit breaker measures have been relaxed. People can go supermarkets to do some therapeutic shopping at supermarkets. I like that. But I do see this trend persisting, which means more and more sales being done on, because groceries can be quite heavy to carry. Maybe that's a reason. And people have gotten used to buying supermarket requirements fully online. So if you've been following this channel, you do know I'm a fan of Sheng Siong. I do own Sheng Siong shares. I've covered before in various other videos, which I'll leave links below. And this is actually a pretty worrying sign because Sheng Siong is not very good with their e-commerce. I look at their platform and it's quite dinosaur. It's really very old-fashioned. Hopefully they'll be investing in something because this is a growing part and they should be tapping on it with all their attention. And the other interesting point that I'd like to share with you, just in case you're also a fan of Sheng Siong, is that supermarket revenue has actually peaked out. And that peak was actually clocked in May. Let me pull up this for you to see. You are seeing month by month decline in terms of total retail sales by supermarkets. That goes to show that after May onwards, people are so tired of cooking at home, baking at home. These are things that we used to do in circuit breaker, but as of now, we just want to go back to the malls. So again, this decline could persist for the next couple of months, and it's something to take note of, especially if you're looking to invest into Sheng Siong or Dairy Farm, which has supermarket business in Singapore itself. Now in this next segment, let's touch on electronics and furniture sales. And let me pull up the graph again for you to see. The yellow line shows furniture sales and the red line shows electronic sales. And what can we see is that both of them actually peaked out in terms of percentage being done online as of May. I mean, that's logical because at that point, circuit breaker measures were so tight. Retail outlets were not being open. So everything that you require, you have to buy it online. So they are non-discretionary. It just explains why that percentage was so high. But the interesting point to note is actually the trend after measures were being relaxed, that people can actually go to retail malls, retail outlets to actually go and see and touch the various inventory that they're looking for. So the yellow line again is in furniture sales, and what can we see is after circuit breaker measures were relaxed, percentage of furniture sales being done online dropped tremendously, all the way now to 20% as of July. My guess is if you're looking for a cheap furniture, a desk or an office chair, you are quite okay buy based on reviews. But if you're looking for a mattress, you really need to test it. If you're looking for a solid leather sofa, you really want to go and touch and feel it. So furniture sales is not going to be replaced fully by online or e-commerce. But the same cannot be said of electronic sales because they also experience a decline, but the decline is much less, which means people are actually quite comfortable buying electronics online. They can just buy a phone based on reviews, they can just buy PC based on reviews. And that is how consumers really think. So if you're looking for e-commerce, go in terms of electronics because that is just, in my opinion, the low-hanging fruit. And that's why I thought of a key discussion point also. This company, Challenger, is also listed in Singapore. If you go to the malls, you can see them quite frequently. IMM, if you know, has also a Challenger. And this article, which I'll pull up for you to see, is Challenger was once being offered 56 cents to delist. That was in June 2019. As of now, because of this pandemic, share price is at least 10 cents less than this 56 cents. So the key part is Challenger cheap enough to get invested, or that they are not being able to evolve quickly enough for e-commerce sales? That is something that you can consider, something that gives you exposure, especially if you want to take part in retail recovery, especially in the electronic segment. So Challenger is an interesting point for you to think further. If you're keen to find out more, let me know in the comment sections. I can do a full explanation on Challenger as a future topic also. Now in this next segment, I'll be touching on F&B sales because F&B is a very important component to the retail scene itself, and later I'll be sharing with you a key reason why. And before you get there, smash on like so more people can see valuable content like this, and press on the subscribe. Join our family, become more financially savvy because there'll be videos every week to help you in your financial journey. Now let me pull this up for you to see again. F&B numbers as of July based on CICT. Total sales 665 million, which is very sizable. F&B is a very important percentage of total retail sales. And very interestingly, total online sales is only 21.1%. Now, I thought that the numbers will be high because there's so much Grab food riders moving around, Foodpanda riders, and actually only 21.1% is generated online. So that's very interesting. But let's pull back up the graph to show you the whole trend of F&B itself. The interesting number to note also is, as of January, it clocked close to $1 billion in total sales. And that's a number to keep in mind because if we see full recovery, we should surpass that number very easily in the next few months. And looking back at the history of how this pandemic actually played out, F&B indeed was one of the biggest losers of this whole lockdown phase because they actually saw their total pie shrinking tremendously. So indeed, F&B actually suffered a lot. And what we can learn from this is actually in April, that was the worst part for F&B total sales. But if you look in terms of share price, how does it look for a particular company in this sector? Let me pull this up for you to see. Jumbo Restaurant. Jumbo actually saw the bottoming of its price in March. So that's something to keep in mind. A share price is always forward-looking, which means that the bottom of the share price was actually ahead of the actual business itself. Of course, that we don't know about Jumbo's profitability. It's just showing the overall pie shrinking and expanding. But also it has a lot of logic that share price is always running faster than the real underlying business dynamics of things. Now let me pull up the graph for you to see again how things actually recover in the next couple of months. Because keep in mind, phase 2 of circuit breaker meant that people, everybody, you and me, we could go out to malls to meet itself. And that's why we see this recovery, this strong recovery for F&B's total sales. Now take a guess, in this recovery, did the online sales actually recover? The answer surprisingly is no. I have this to show you over here. Total sales online for F&B retail actually peaked out in May. Subsequently in June and July, the numbers were actually lower. Very surprising, correct? Because as people started to spend more, actually they went back to the malls to spend. They didn't order the things online. So that's very interesting to note especially. Now, that is a very important finding because F&B outlets actually dominate the retail malls itself. If you go to any first floor, you go Bugis Junction, you see McDonald's on first floor. You go to Umbra Plaza, you see McDonald's on first floor. You realize that F&B are actually occupying the best retail space in the mall itself. They are the biggest contributors. And let me pull this up for you to see. F&B contributes about 1/3 of total revenue for Capital Mall Trust itself. That's why they are about the highest per square foot payers in terms of tenant. So that's something important to note. And what we can see from Capital Mall Trust is that footfall has been recovering very quickly. People are going to the malls. Actually, you don't see this chart. You yourself, you probably know, look at your daily schedule, you're probably visiting the malls a lot more. That's why malls are getting crowded. We might even bump into each other in the mall itself. Now, if you're looking in terms of F&B, I have a different name to suggest to you. You can, of course, invest in the REITs because F&B recovers, which means REITs will likely survive pretty well. F&B is their core component. If they do well, REITs will survive. It's not true that e-commerce will really disrupt everything and REITs are threatened. It's not really true from the data points I've shown you. But if you don't want jumbo seafood, you feel that restaurant business is very dangerous, especially if there's a risk of a second infection and stuff and we have more measures, look instead to Koufu because Koufu is much more diversified. Koufu is a king for F&B in Singapore. They have food courts, they have restaurants, they have bubble tea outlets. I have a previous video on it. And just to show you numbers, food courts are a lot more resilient. If you look at numbers in terms of May, food courts actually lost about 41% year-on-year comparison, but restaurants actually suffered 68% difference. So food courts are definitely a lot more resilient. Nonetheless, Koufu has both businesses. So however it plays out in the retail space for F&B, if you invest in Kofu, you are definitely getting that exposure. So I'd like to invite you to that previous video I've actually covered on Kofu before. And if you haven't seen that, something very interesting on Kofu is in that video itself. I would like to invite you to watch that. With that, I'll sign off. I'll see you in that video. Take care and goodbye.